Hi friends, today we are going to discuss about income statement. So in financial accounting, income statement is one of the key financial statement. So what are the three different financial statements which are critical in accounting? So one is balance sheet and income statement, and then cash flow statement. So this video we are going to discuss in detail about income statement. So let us also look at high level what is balance sheet and cash flow statement as well, but then we will look into in detail about income statement. So if you want to have a look at balance sheet and cash flow statements, you can look at my other videos which will explain you in detail. So friends, if you have not subscribed to my channel, subscribe to my channel and like the video, share the video, whoever you think it is useful, beneficial, and also press bell icon if you want to watch my latest videos. So let us get into three important financial statements. What are those financial statements? One is balance sheet, second income statement, and third cash flow statement. So all these three financial statements are very critical, and these statements will give you what is the business health of your organization, right? So what it gives, it gives health of the business. So by looking at these three statements of any company, you can easily tell what is the health of the business, right? So now if you look at balance sheet in brief, so what you will have here is assets equal to liabilities plus equity, right? So in assets again you will have two different types, fixed assets and current assets. So fixed assets where you get revenue generated in long term which is greater than 1 year, and current assets which will generate revenue less than 1 year. So fixed assets like land, properties, machinery, and current assets like some inventory, right? Where you can convert them into finished goods and sell, and you can get the revenue. So this is briefly about assets. And then liabilities, when you take any loan or from a bank or from any other friends or relatives, so that you need to pay them back, so it becomes a liability. And equity is something which either you invest, self investment, or from your friends or relatives. So this is equity, right? So always assets will be equal to liabilities plus equity. See, whatever the revenue that you generate which comes out of income statement goes into this equity, retained earnings, right? So that is a link between balance sheet and income statement. So now let us look at what is income statement in brief, and then we will look at in detail later on. Income right. So it's very simple. You take revenue and remove expenses, which is either profit or loss. This is called income statement. These retained earnings will go to balance sheet into cash asset as well as equity, right? So then the third one is cash flow statement. So what is cash flow statement? It is very simple. It will show overall statement of cash, how it is flowing. Whatever cash in is added into this statement, and whatever the cash out from business is also added into cash flow statements. So this is what you will get, net cash flow, right? So this is overall about three different type of statements that we generally use. So now let us get into the details of actual topic, income statement. Right, so what is income statement? Income statement, it is a summary of business revenues, like we have seen before, summary of business revenue and expenses over a period of time. This is over a period of time, maybe mostly yearly or sometimes quarterly. You can even do it daily or monthly, but generally they do it yearly, right? So this is what is income statement, and it is also called, what is the different name we can give it for this? P&L, right? Let me select any other color. Profit and loss, or P&L account, right? This is also called P&L statement, or you can also call this as statement of earnings, or you can also call statement of operations, right? So we can call this as either income statement or profit and loss, P&L, or statement of earnings or statement of operations, right? So this is what income statement all about. So let us look into some examples and also discuss about what is this revenue and expenses. So how you calculate profit and loss? So let's look at the formula first. Revenue minus expenses, right? This is either profit or loss, correct? For example, if the revenue is more than expenses, let's say your revenue is 100 rupees, expenses are 60 rupees. So this is profit, right? For example, if your revenue is 100 but expenses are 120 rupees, then it is loss, correct? In simple terms, this is how you calculate income, right? This is clear, I think, right? This is very simple. So now let's look at what are the type of revenues and what are the type of expenses. Let us go further detail into it and then understand what are the various aspects about revenue and expenses. So first let us look at revenue. So revenue, how you get money? Either you get from sales, product sales. So let's say you are having a sales of you are manufacturing tables and then you are selling tables. So by selling these tables, you will generate some amount, XXX amount, right? This is what revenue. Or you can also get revenue by services. So if you are rendering some services, right, you will generate some money. So either through products or services, you generate this revenue. Correct? Is it clear? Okay. So now, if you have any doubts, you can mention in the comment section so that I can clarify. Now let us look at expenses. So expenses are also like you will have two types. One is direct, another is indirect. Direct, indirect. So what is direct cost and what is indirect cost? So again, in this indirect cost, you will have fixed or variable. So what is direct cost? So direct cost, let's say you are manufacturing table, right? So you need some raw material for this, right? So what I'm trying to say is to manufacture this table, whatever the direct cost that you are incurring, right, can be taken as direct cost. Or for example, either you have a manufacturing unit, you are supposed to manufacture tables. If you manufacture tables, then you will have a direct cost. But if your staff is sitting idle, maybe because there is no demand, and then you are not doing manufacturing right now, but still you will have some indirect expenses. What are those indirect expenses you will have? Irrespective of whether you manufacture tables or not, you will have, because you need to pay rent, you need to pay salaries, right? You need to pay maybe insurance sometimes, you need to pay admin expenses, you need to pay legal sometimes if it is a big firm, right? You need to pay accounting, marketing, right? And sometimes you will have depreciation, right? So all these are overheads. Even if you don't do manufacturing of tables, you will still need to incur all these expenditure. So this is what we call about indirect expenses. Okay, so now let us look at this direct expenses, also called as cost of goods sold. Cost of goods sold. So let us take some example and see how we can make one income statement. Okay, so now income for XYZ limited, and let's say for the period of quarter ending 31st March, right? So let's take an example of you have, let's take the same example like manufacturing unit having for tables, right? Okay, so now let's say you have generated a revenue of by selling the tables, right? You have sold the tables and you have generated a revenue of how much? Let's say 100 million. Okay, INR. Let's consider all these numbers are in million. Okay, so now, and what is the cost for manufacturing all the tables? Let's say you have got 100 million by selling 10 million tables. So for manufacturing these tables, you have incurred some direct cost, correct? For raw material or whatever. So what is that cost? So that cost is cost of goods sold for this 10 million tables. So what is the cost of goods sold? Let's say for example it is about 40 million INR. So now what is the profit? This profit is gross profit. So we call this as gross profit, that is 60 million. So till this it is clear, right? So this is very simple because we have just taken what is the total revenue that you have earned by selling 10 million tables, and then what is the cost incurred to manufacture this 10 million direct cost, right? That is 40 million. And then 100 minus 40 is the gross profit. So this we can take it as a gross profit for the particular quarter based on this income statement. So now once you get gross profit, you still have some other expenses, right? So where you will account for all those expenses, they are all indirect expenses. So let's say now you have gross profit of 60 million. So what we should do now? So gross profit is 60 million. So from this you need to reduce all indirect expenses. Indirect expenses, right? So indirect expenses can be anything like salaries or rent or right marketing expenses, etc., etc., right? So what we should do here, this indirect expenses we need reduce from gross profit. So let's say this total indirect expenses are around 20 million. So now once you reduce this expenses, you are getting 40 million. So this is, we call it as operating profit. We can also call this as EBITDA. EBITDA, right? So what is EBITDA? Full form, right? So we can also say EBITDA means earning before, you can have this earning before interest, I is interest, T is tax. So you need to pay interest, you need to pay tax, you need to pay, you need to reduce depreciation, amortization, right? So all these things we need to reduce, but we have not yet reduced. So that is the reason this is the profit. We call it as EBITDA, right? So what is EBITDA? Earning before interest, tax, depreciation, amortization, right? So this is what we call as operating profit. So now once you get this EBITDA value, what we should do is we should further reduce depreciation and amortization. Let's say depreciation or amortization. So for example, why we have to reduce depreciation? Because for example, if you have a machinery worth of 10 lakhs, right? So if you think the lifetime of this machinery is 10 years, right? So per year 1 lakh is the value that will depreciate. 1 year 1 lakh. So for example, you have 10 lakhs worth of material here, yeah, or machinery here, or land or buildings here. So once you decide the period, then you can calculate the per year depreciation amount, and then you should reduce it. For example, you take that depreciation as 1 million. Okay, so now if you reduce, after reducing this depreciation, it will come as 39 million. So this we call it as EBIT, because now we have reduced depreciation and amortization. Here we didn't consider amortization, but if you have to consider amortization as well. So once you remove these two, this is left out is EBIT, right? So what is EBIT? Earning before interest and tax. So once this is done, what you have to do to get the final profit, you need to reduce minus interest and minus tax, right? So let's say your interest is around 2 million, and tax maybe at 30% or 20%, but just let's take an example of another 3 million. So now overall you need to reduce 5 million, right? So if you reduce 5 million, finally what you will have left out with 39 is 9 minus 5 is 34 million. So this 34 million is what you call net profit, right? This is net profit. So this we call it as net profit. So we got net profit of how much? 34 million. So this is how we prepare in income statement, correct? So friends, this is all about income statement, and if you have any doubts, you can mention in the comment section so that I can clarify. And please, if you have not subscribed to this channel, go ahead and subscribe to this channel, and also like the video and then share this video if you think it is useful for any of your friends, and then also press bell icon if you want to watch my latest videos. So thanks for watching, and enjoy your income statement preparation. And if you have any doubts, you can leave comments in the comment section. See you next time.